Well, welcome to 2020. So what's it going to be like? If austerity is gone, will we see a bright future for Britain, or will it be dragged down by Brexit? Is this the year that Donald Trump gets re-elected, or will the US economy take a turn for the worst and drag him down with it? And will housing bounce back in Australia and see their economy back on an upward trajectory? And climate change, is this the year we finally start to take notice? And if so, what does that mean for the economy? I'm Phil Dobbie, and welcome to the first Debunking Economics podcast of 2020 with Professor Steve Keen. So 2019 feels like it's been a fairly rocky year, Steve. I mean, we've had part of Europe on the brink of recession. Donald Trump, of course, has been declaring trade wars on China and other parts of the world as well. And we've had Brexit, and now we've got Boris Johnson. I'm not sure which is worse. So what of 2020? Are things going to die down, or are they going to get worse, or will it be more of the same? I mean, for example, are we heading for a recession? If you believe in trade cycles, we can't be heading for recession because we really haven't had that growth spurt from the last recession.
Yeah, well, what we've had is 10 years of stagnation. I mean, the term which the mainstream used, this is Larry Summers, dragging it back out of the 1930s when it was first put up by Alvin Hansen, is secular stagnation. It's not cyclical. They say there's been a secular change. And when you look at the explanation that Hansen gave for it and that Larry Summers has pretty much regurgitated, that's a good word, isn't it? Is basically that parents are having less kids and engineers are having less ideas. And because population growth and technical change are the two drivers of economic growth.
Nothing to do with the economy then, it's everyone else's fault.
No, nothing the economists did wrong, just a secular trend to lower growth.
Right.
And that's what Hansen actually used back in, first of all, in 1934 to try to explain the crisis to 1933 when unemployment rose from a recorded level of 0% to 26% over 2.5, 3 years. Then they all thought it was all hunky-dory by 1936. In America, it had fallen to 11%. So we've gone from 26% to 11% unemployment. And thank God the rest was all behind us. Mainstream economists persuaded Roosevelt to get back to balance the budget again. Roosevelt attempted to do that. So the stimulus from the New Deal, which was worth only about 3% of GDP. It's quite a small level compared to what we're used to these days. He went back to trying to balance the books again. Unemployment shot up from 11% to 20%.
Right. But where we are now, it doesn't feel like we're on the brink of a recession because employment is holding up everywhere.
Yeah.
In fact, in many places it's getting better, like in the US, even in Australia, which you'd say is not in a good place, people are still employed.
Yeah, and I think this is partly the impact. If we had lower growth than we had previously, but lower population growth as well, so that the parents having less babies is true in most of the OECD. Australia's managed to fudge it by having population growths. So when you take our population growth out of Australian economic performance, because it's got almost the highest level of population growth in the world, but it's almost all driven by migration. So you take that out, and Australia's been what the macro business has been calling a per capita recession for a year or two now. So that's a bit of a fudge of the figures. But globally, it's true, lower population growth, and that does mean less people, and that will mean less output, less heads producing output. So, but at the per capita level, there's also been a decline in the per capita rate of growth. So if you look at the average before the financial crisis for America for about the last 20 years, the average rate of growth was about 3.2% per annum. Now it's running at 1.7%. So it's a substantial fall. Yeah. But you've also had...
But we're getting by, aren't we? If we look in America, for example, I mean, America's, growth is it's not really hitting 2% yet. It's certainly not up to 3%. And yet, all the other indicators are good. Employment's strong. Personal consumption's okay. Well, people are buying shares like they're going out of fashion.
Well, they're selling shares like they're out of fashion because the buyer of the shares is the financial sector, and the reason the financial sector is buying shares is because of quantitative easing. So I've seen QE as being flattening out the business cycle because part of the government is using the capacity the government has to create unlimited amounts of money to pump up asset markets. This is quantitative easing. And I made the claim back in 2016 that once they started, they'd be stuck with it. It was a pact with the devil. Because if you try to pull out of it, the asset markets which get pumped up by it will collapse. And the first response of the central banks, they really don't react to unemployment until it gets critical. But a fall in the stock market, they panic and go back into quantitative easing again.
So if Australia goes down that road, which the RBA is talking about, 2 more rate cuts, and then they're going to look at quantitative easing,
Yeah.
that's going to be a big mistake for Australia.
Well, it'll have this. It's quantitative easing does work at great expense in terms of transferring money from the real economy to the financial sector. Because my basic logic is for QE is that America was doing $1 trillion a year worth of QE. That means they're buying $1 trillion worth of bonds off the financial sector. That means the financial sector has its bond count down by 1 trillion and its cash count go up by 1 trillion. Now, bonds, even if they're dodgy, they're still earning an income flow. So they've gone from having an income earning asset to a non-income earning asset. What do they do with the non-income earning asset?
Buy shares.
They buy shares, which drives up the share market. Now, that has pumped up the S&P from 666, which is the bottom I'll never forget because of it's the mark of the devil, to about 3 or 4 times that.
Yeah.
And then if you look at what happens, the finance sector people get wealthier. Well, they spend a bit of that. They buy an extra Lamborghini. They get somebody to clean the Lamborghini for them. That triples back into the real economy. And if you do like a very, very back of the envelope type calculation, you can sort of say, well, $1 trillion per year of QE may give $100 billion per year worth of stimulus.
Didn't you just argue just now for trickle-down economics? Didn't you just...
It trickles down, but 90% of it remains in the top champagne glass.
Right.
And that's the trouble.
And so this means that the US is going to do okay then, in 2020?
I don't expect a recession in the US.
Donald Trump's going to get in again because the economy's doing well and he's tweeting about how magnificently it's doing.
Quite possibly. I mean, if he has a battle against Bernie, he might lose, but I think if he fights against Biden, he'll almost certainly win. So I'm expecting another 4 years of Donald Trump.
And it's interesting, isn't it, that all the tariffs that he's imposed, the US seems to be doing quite well out of it.
Well, see, this is again, I wasn't fussed about the trade war thing because the reason economists obsess about trade wars and say it's going to, we're all going to be ruined tomorrow. You remember the predictions for Brexit the day after the vote went through, the economy would collapse. That worked out well, didn't it? I was one of the 2 economists saying there would be no particular big deal. Myself and Richard Werner. Richard did the econometrics on it. We both say credit's the major driver. No particular change in credit, no particular change in the economy on the other side of the vote. Same thing for the actual impact of Brexit. If you were going back to the 1950s when tariff levels were 30, 50, 40, 50%, and you're going to go from zero tariffs exporting to the UK to Europe to 30, 40%, then that's big. Okay, at the moment it's sort of 2 and 3.
Yeah, but with China we are talking about that sort of level. They are getting up to that sort of level.
Well, that's what Trump's doing in the war itself. But overall, the economists obsess about specialisation and fundamentally ignore investment. I think savings becomes investment. There's more savings, more investment. Simple. They obsess about specialisation, so they get really worried about a trade war. I think it's going to have a huge impact. Most of the time, most of the impact of a trade war is taken by the distributors. They've got a large profit margin. The tariff level goes up. They've got to pay more for some of their inputs. They tend to absorb that in their margin. Not much happens to consumers.
And we also see currency shifts as well, of course. So that can adopt
and that goes the opposite direction. That sort of compensates for the tariff change. So I wasn't particularly... yes, it's annoying. It's going to damage supply chains. And part of the reason he's damaging supply chains is the belief this will mean that American manufacturers relocate production from China back to America, which they may or may not do. They've certainly got to do some investment. So it's a swings and roundabouts number, and there are more swings than roundabouts. I can see it damaging the economy, but nothing like the level of neoclassical economists predict.
Right. So not a bad year for the US then?
Not a bad year, but most likely the big thing that's happening is financial fragility. Because what my main focus when I do my Minsky work is on the macroeconomics of it. But there's also how robust is your financial sector, and that comes down to how volatile is the valuation of the assets they have, because the assets. A financial institution must have positive net worth. Its assets must exceed its liabilities, or it has to declare bankruptcy. The rest of us can survive with negative equity. Okay, we actually do that. If we didn't have a government, we'd all be in negative equity. The banks would be in positive equity. We'd be in negative equity. That's a given in the absence of government money. Okay? And that's what's one of the fundamental instabilities of capitalism that Austrians don't have their heads around, nor do neoclassicals. But with the banks being in positive equity, but with assets earning such a low level, a lot of what they're doing is they're buying junk bonds, They're taking risky ventures. So that means that it's quite possible for banks to suddenly find that asset they purchased is garbage, and bang, the price collapses, and then they're in negative equity and they go bankrupt, and there could be a chain reaction.
And that is just the first part of our predictions for what's going to happen this year. If you want to hear it in full, there's another 20 or 25 minutes of this. Then you need to become a supporter of Steve Keen on Patreon. Go to patreon.com/Prof Steve Keen. Choose a supporting plan there and get access to this and all the other podcasts in this series. Or you can become a subscriber at debunkingeconomics.com. Hopefully you'll do that. You'll get to hear this in full and all the other podcasts in this series as well. We'll be back again next week. I'm Phil Dobbie. He's Steve Keen. Thanks for listening.